Hello and welcome to The Bulletin with UBS on Monocle Radio. Each week, the sharpest minds and freshest thinkers in finance take you beyond the numbers and hype, right to the heart of the big issues of the day. I'm Chris Chermak, stepping in this week for Tom Edwards. Today, in the light of ongoing moves from the Oval Office since President Donald Trump's inauguration, we're focusing on tariffs and trade. We'll hear from UBS Global Wealth Management Chief Economist Paul Donovan, who's going to talk us through his recent research report on a possible Bermuda Triangle affecting Chinese exports to the United States. When looking at trade between two countries, the value of exports should be lower than the value of imports received on the other end, because in between the two are costs for shipping and insurance. In recent years, though, the value of China's reported exports to the U.S. have exceeded the value of the U.S.'s recorded imports from China. This suggests that up to 30% of China's exports to the U.S. are disappearing before they arrive. The anomaly is not evenly distributed across sectors, and it didn't start at the same time for all sectors either. The pattern does suggest that it is closely linked to the imposition of trade tariffs. So how to make sense of the data? And what does it all mean for the direction of travel under Trump 2.0? Well, let's hear from Paul Donovan now. I began by asking Paul to untangle this apparent anomaly in the trade data. How can China be exporting more to the U.S. than the U.S. is importing from China?
Well, essentially there are two possibilities. Either a lot of ships are sinking in the middle of the Pacific Ocean, which is not the case, or alternatively, somebody's figures are perhaps less than accurate. And this is a very unusual situation because normally the value of exports should be below the value of imports in another country. And that's because exports measure the price of goods leaving a country and imports measure the price of goods arriving in another country. And in between the two, you've obviously got shipping costs and insurance costs. So to have those numbers flip around and exports higher than import pricings, that tells you that something is wrong with the numbers.
And we're not just talking about a small amount here. This anomaly is more than 30% when you factor in the things like shipping and insurance that you were talking about.
Absolutely. And when we burrow into the detail of the data, a story starts to emerge because traditionally China's exports and US imports were behaving normally. We had a perfectly normal process. But then as President Trump started to impose tariffs during their first term in office, what happened was the numbers started to flip. And when you go through on a sector by sector basis, essentially when tariffs are imposed, the value of China's exports suddenly starts becoming higher than the value of US imports. So what that is very, very suggestive of is China rerouting its exports via third-party countries. So China doesn't sell direct to the States, it sells to the US via Canada or Mexico or Vietnam or wherever, and that enables US customers to say, no, this isn't a Chinese good. Look at the maple leaf on the side of the box. Clearly it's come from Canada, and avoid paying the tax.
And to be clear here, Paul, you have not inspected these ships yourself, as it were, but what you've seen is this very clear correlation in the data because it matters what goods we're talking about, and where you see this discrepancy in the data, it depends on which goods you're looking at and when.
Exactly, because tariffs have not been applied to all goods from China, historically speaking. And quite a lot of goods from China to the United States were traditionally exempt from tariffs. And those goods, the behavior of the export numbers and the import numbers is perfectly normal. But where you see tariffs being applied, so steel, for example, early on, or furniture or electronics, which came in Trump's first term, when those tariffs are imposed, within a year, the numbers start doing funny things. And that's what is giving us this very strong hint about the rerouting of China's exports to the United States.
And Paul, this isn't, of course, just about data. I mean, as you explain it there, China will actually be essentially circumventing tariffs by doing this, and the U.S. will be taxing less than economists might expect. So there is a real-world economic impact to all of this.
Yes, what this really means is that when we want to assess the impact of a trade tax from the US or indeed from anybody, what you need to do is focus on the importing country's data. So in this case, we need to focus on the US data. If we want to work out what the impact of a trade tax is going to be on China's exports, we don't use China's export numbers. We use the US import numbers because that is what the tax is actually applied on. You know, a tariff is a tax paid by domestic consumers, and so it's the domestic import data that is relevant because that's got what is going to be used to calculate the amount of tax owed. So when we're thinking about the economics of this, we need to focus on the import data of the recipient country. That's going to be the relevant number.
And Paul, also to be clear on this then, what this is showing is basically the pitfalls of selective tariffs. This is when a tariff is applied on one country like China. Presumably this would be a little bit harder with, say, Canada and Mexico, but China is one that is able to circumvent a selective tariff like this.
Exactly. So selective tariffs apply to one country. You can reroute and alter your supply chains overall. Now, as you say, Canada and Mexico, which primarily have land borders, it doesn't make a lot of sense for Canada to route its goods via the United Kingdom to avoid paying a trade tax. That's not likely to happen. But, you know, aside from Canada and Mexico, most goods do go via quite long routes to get to the United States. So there are plenty of opportunities to adjust the route on the way into the United States and avoid the tariff. Now, of course, if you have a universal tariff, that is to say, all imports into the United States are subject to a tax. The tax on US consumers of steel and aluminium from overseas at the moment is a universal tariff. It applies to all imports, or will apply to all imports of steel and aluminium. That is a lot more difficult to avoid because, of course, the only way of avoiding a universal tariff is by smuggling. Something the Americans did a lot when the British were running the place, but it's not really practical in the modern world.
Well, and that's kind of one of the questions I had for you, Paul, as well, because does that suggest perhaps that the Trump administration, Trump 2.0, as it were, has learned from this somewhat? The fact that their recent blanket 25% tariffs on steel and aluminium were imposed on all countries, are they perhaps moving away from selective tariffs?
I don't think so. I think it will always be a mix because selective tariffs, like most tariffs, are political in their nature. Essentially, very often selective tariffs are about demonizing a certain country. You know, this is China being unfair in their trade practices. And whether China is being unfair or not is a moot point. You know, what the administration wants to do is to demonize China. And so a selective tariff is the way to do that. Universal tariffs are better at collecting the tax revenue, but of course they're also a lot more damaging to the economy. All tariffs are a tax increase, and like any tax increase, that's going to be damaging for growth. But universal tariffs are particularly damaging because you don't get that evasion and so on and so forth, and it creates a significantly less competitive environment, which allows domestic firms to push through price increases and further hurt consumers. So I think we will see this mix of universal on certain products, generally very politicized products where the US has got a competitor industry, steel and aluminium, very obvious one, possibly pharmaceuticals, possibly autos. These are areas which are often mentioned as being subject for universal tariff. But then alongside that, we will see these sort of continual selective tariffs with a political narrative as well as an economic one.
And if there is that political narrative as it suggests, does that mean that from your perspective as an economist, you don't expect the United States to try and correct for this when it is imposing selective tariffs to, I don't know, perhaps try and, change its own data or look at exactly where the ships are coming from, where the origin is as opposed to where it has just arrived from?
I think there certainly is an attempt to try and do that. There is a frustration about the fact that such a large proportion of China's exports to the States are able to evade tariffs. But of course, it is very difficult to do. Global supply chains are extraordinarily complicated things. Majority of global trade takes place inside companies. It's a company moving goods from one subsidiary to another. And so trying to spot this is a Chinese product is actually not nearly as simplistic as it sounds. This isn't the 1970s. We're not in the Nixon era with an imperial model of trade where you import foreign materials, make everything at home and export of finished goods. We've got these very, very long, complex supply chains, and that makes the job of identifying the origin of certain products a lot more complicated to do. So I think this is still going to be an ongoing problem for the United States in trying to levy taxes on imports of foreign goods. We'll go backwards and forwards with this, I think, for the course of this administration.
And if we are going to go backwards and forwards, then I guess the question for me would be, what is your actual prediction of how much of an effect Trump's tariffs on China will have? Will we see a kind of diminishing effect of these tariffs because of exactly what you're describing? Or do you expect that the U.S. will be able to sort of, challenge some of this, and therefore there will be a bigger hit to the economy than one might expect?
Well, what you've got to expect is that in the early stages, the tariff sort of hits with almost full force. You can't reroute supply chains overnight. And we do expect that the effective tariff rate, which before the Trump administration was 10.4% against China, now it's probably about 17, 18% with the latest taxes, probably will go up to 30% over time. Now, that's significant. But then over the course of 2-3 years, the impact of that tariff will decay. Now, it doesn't go all the way back down to 10%, nothing like that, but it just becomes less effective over time as people find ways of adapting and avoiding the tariff over time. So I think that it will have an upfront impact, and that impact would then decay over time. But the thing about tariffs is that a lot of the economic damage that comes from tariff is not necessarily the direct effect of the tax, although that is obviously damaging, but it's what we call the second round effects. So it's US companies raising prices because they're not facing so much foreign competition. It's retailers exploiting the situation to increase profit margins and raise prices more than they need to in response to a trade tax. So those second round effects and the uncertainties that they cause are potentially more damaging. And then, of course, there's also the risk that US companies that are using, for example, steel and aluminium from overseas become less competitive, have to lay off workers, and that creates a different economic second round effect. So the direct impact of the tariffs absolutely will decay over time. Those second round effects, though, that's where the damage really comes in.
And when it comes to those second round effects, Paul, I mean, obviously much of this is uncertain because we don't know the exact level of tariffs necessarily yet and how much Donald Trump and the administration are going to follow through on this. But what is your prediction of how damaging these second round effects could be on the U.S. economy?
It is very tricky because it's not just the uncertainty about the policy, it's also uncertainty about the response. Do we see domestic companies pushing up their prices, or are they going to try and increase their market share instead? Do we see consumers sort of saying, oh, well, we've got to accept the price increase, allowing retailers to push up prices more than they should, or are consumers going to be more price sensitive? Overall, I think that the US economy is likely to slow this year as a consequence of the tariffs, and US inflation is unlikely to come down very much as a consequence of the tariffs and the second round effects. But I don't think we're going to see a recession or anything like that. We've got to remember that imports into the United States account for a little bit more than 12.5% of the economy. So, it's quite a small part of the economy that we're talking about, though the second round effects do give it disproportionate impact.
And just finally, Paul, to go back to this trading relationship between the U.S. and China specifically, you've talked about how China is attempting to circumvent the tariffs imposed on it. Are there any other things that you expect China to do in order to adjust its trading relationship with the United States as a result of any tariffs imposed? We are seeing, of course, other countries saying they will invest more in the U.S., Japan being one of those, for example, to try and avoid tariffs. Do you expect China to do anything along those lines?
Well, to be clear, what China is doing is helping US consumers avoid the tariffs, because it's the US consumer that has to pay. And so that's what the rerouting is all about. With regards to other measures, yes, you might see some more investment. I think that it's not that likely, to be perfectly honest. Particularly from China's perspective, because whilst localization of production is a thing, I don't think China necessarily has a great deal of confidence that, if they invest in the United States, the trading conditions that are then agreed will endure. This is one of the problems. How much confidence do you have that an agreement that the Trump administration makes on trade today is going to be honored in 2 years, 3 years, 4 years' time? If you're making a 20-year investment, you need to have a high degree of confidence about the contract being honored. But President Trump has effectively torn up the renegotiated NAFTA contract with Mexico and Canada already, and that is starting to raise questions about just how confident you would be about investing for the longer term.
Just finally follow up on that, Paul. Do you expect China, though, to perhaps also look at actually trading more with other nations, not just sending its goods via other nations to the U.S.? Could there be a bit more of a permanent shift to sending goods to other nations as a result of all this?
I think it's certainly likely to be the case that you will see shifts in trading patterns. We've got to reflect, though, that localization, that is to say using automation and robotics to produce locally, is a thing. And so the global level of trade as a share of the global economy was likely to decline anyway. I think what China is also certainly going to be doing is trying to boost its domestic economy, try and increase consumer spending, not necessarily on goods, but on services. And that will be one of the features for this year, to become less dependent on global trade generally as a driver of growth. That would be a sensible strategy, given the trends towards localization that we're seeing, not just in the United States, but around the world as a function of technological change.
Paul Donovan, thank you for joining and bringing us to the end of this edition of The Bulletin with UBS, setting the agenda in the fast-moving world of finance every week here on Monocle Radio. Listen again and explore at monocle.com. That is where you can join the club by subscribing to Monocle Magazine. You can also follow this program wherever you get your podcasts, or discover more and find out how UBS can help you at ubs.com. This is The Bulletin with UBS on Monocle Radio. I'm Chris Chermak. Thanks for listening.